Kevin Warsh could cut interest rates, and your mortgage could still become more expensive. That sounds impossible, but the 30-year Treasury yield just reached its highest level since 2007. And now, Warsh is considering giving markets fewer chances to hear from the Federal Reserve. The central bank controls one interest rate. The bond market increasingly controls the one hitting your wallet. Here is what changed. The Fed normally holds 8 scheduled policy meetings each year. Warsh is considering cutting that number to 6. 2 fewer decisions. 2 fewer press conferences. 2 fewer scheduled opportunities for investors, banks, and borrowers to understand where monetary policy is heading. This is not just a calendar adjustment. It could represent a structural shift in how the Fed manages the market. And it is happening at the worst possible moment. The 30-year Treasury yield just touched 5.28%. That is its highest level in 19 years. The 10-year yield, which heavily influences mortgage rates, has also been moving higher. Even a half-point increase in mortgage rates can add roughly $130 a month to the payment on a $400,000 30-year mortgage. That is more than $1,500 a year. This is not abstract pain on a trading screen. It is money disappearing from a family's monthly budget. Here is the mechanism. The Fed directly controls the overnight interest rate. That shapes the cost of very short-term money. But families do not buy homes with overnight loans. Companies do not finance factories for one evening. And the United States government does not fund trillions of dollars of debt one day at a time. Long-term borrowing costs are set in the bond market. Those investors must decide how much compensation they need for inflation, government deficits, policy uncertainty, and the risk of lending money for decades. And right now, they are demanding more. Some traders are positioning for the 10-year yield to approach 4.9% and the 30-year yield to break 5.4%. That would place even more pressure on mortgage rates, business borrowing, federal interest costs, and asset prices. The yield curve is steepening. Short-term rates are relatively stable, while long-term rates are breaking higher. That gap is the bond market's verdict. Investors want a larger premium for lending to America over the long term. Part of that premium reflects inflation risk. Part reflects massive government borrowing. And part may reflect uncertainty about what this new Fed is prepared to do. Warsh has rejected the old system of constant forward guidance. He says surprises are not the objective, but he also refuses to limit himself to a narrow set of policy choices. His goal may be to make markets less dependent on every sentence spoken by the Fed. But there is a dangerous contradiction. The less clarity the Fed provides, the more protection bond investors may demand. And that protection comes in the form of higher yields. This is what almost everyone is missing. The bond market may already be tightening monetary policy on Warsh's behalf. Higher long-term yields make mortgages more expensive. They raise the cost of refinancing corporate debt. They make new housing developments harder to finance. And they increase the amount the government must spend servicing its debt. That is a rate hike without the Fed officially raising rates. Warsh does not need to lift the overnight rate for financial conditions in the real economy to become tighter. The bond market can do it for him. And that creates the real nightmare scenario. Imagine the economy begins to weaken. Hiring slows. Consumers pull back. Warsh responds by cutting the federal funds rate. Normally, borrowers would expect relief. But what happens if long-term investors remain worried about inflation, deficits, and the Fed's credibility? The Fed rate falls. The 10-year Treasury stays high. Mortgage rates barely move, or become even more expensive. The Fed cuts. You still pay more. That is the risk of a central bank that controls the front of the yield curve while confidence controls the rest. Several Fed officials already believe inflation requires tighter policy. Neel Kashkari has warned that waiting too long could eventually force the central bank to act more aggressively. Warsh may believe temporary discomfort is necessary to restore discipline, but that discomfort will not remain contained inside the Treasury market. It will reach housing, business investment, government spending, retirement portfolios, and monthly payments across the country. Kevin Warsh may still control the Fed's interest rate. The question is whether he still controls yours. Subscribe to Global Notes by JP for macro news that reaches your wallet before it reaches the headlines.